let's completely reframe how we look at regulatory compliance today. It is incredibly easy to view the federal tax system as just this series of tedious, administrative annual chores. But if we really pull back the curtain, what we reveal is a massive, intricate data gathering and tracking engine designed to map the entire economy. In this explainer, we are going to act as an analytical engine ourselves. We'll decode the hidden mechanics of this ecosystem, focusing purely on the actionable insights, the implicit assumptions, and exactly how these interconnected gears turn.
To do this, we're going to break this ecosystem down into 4 logical pillars. First, the foundations of business structures. Second, the information reporting engine. Third, cross-border tax mechanics. And finally, professional diligence. Okay, let's dive right into part 1, foundations of business structures and entity mechanics.
Now, here's a really common implicit assumption that we need to break right away. The idea that every tax filing automatically results in a tax bill. Structurally, that is completely false. According to expert analysis, the way a business is structured at its inception actually dictates the exact reporting footprint required by federal authorities. Honestly, structure is destiny when it comes to compliance. Think about informational returns. They act purely as tracking mechanisms. They're designed to establish a record of existence and track transactions, particularly for foreign-owned entities operating within the system. But they don't inherently trigger a tax liability. Taxable returns, on the other hand, well, those are the actual mechanisms for calculating profits and expenses, which ultimately results in a calculated tax payment. So what's the actual trigger mechanism that separates these distinct returns? It all hinges on U.S. connected income. This is essentially a geographical trigger defined by the physical location of your operations. If your revenue is generated through a physical domestic presence, boom, that triggers a mandatory taxable return. But if that physical presence is lacking, even if the entity operates within the jurisdiction, the authorities really just need to trace its existence through an informational return, rather than actually taxing its profits. It's all about physical location. Moving on to part 2, let's look at the information reporting engine, specifically how it tracks transactions. This is where the cause and effect relationship between economic activity and regulatory data gets fascinating, because it relies heavily on strict categorization. The critical structural distinction here lies between the MISC and NEC mechanisms. The MISC form is structurally designed to capture passive income, things like rents, prizes, or royalties, where no active labor was traded. Conversely, the NEC form is the engine's primary sensor for the active gig economy. It exclusively tracks non-employee compensation for freelance and independent contractors. And here is the non-obvious detail. Using the wrong form isn't just a minor administrative typo. It actually triggers mismatched automated assumptions deep within the regulatory agency's systems. When an NEC form is filed, the system implicitly assumes active labor was performed, which immediately flags the taxpayer for self-employment tax liabilities. A MISC form bypasses that automated assumption entirely because the revenue is categorized as passive. Understanding this structural divide is absolutely crucial because misclassification directly corrupts the data fed to the agency, and that leads to automated enforcement actions based on flawed assumptions. And crucially, running alongside these is the K form, which serves as the specialized data sensor for payment card and third-party network transactions. Now look at how the monetary threshold for those third-party network transactions is rapidly shifting. In 2024, the reporting threshold was set at $5,000. In 2025, that drops to $2,500, and by 2026, it plummets to just $600. So what is this really? It's a structural forcing function. Dropping the threshold this drastically eliminates the previous shadow margins of the economy. It forces the microgig and digital resale markets right into the visible regulatory light. The system is structurally designed to capture progressively smaller data points, effectively eliminating unmonitored peer-to-peer economic activity over time. Naturally, this ever-expanding net forces a vital structural question. Does top-line reporting equate to automatic taxation? Like, if a third-party platform reports a gross earnings amount, is that guaranteed to be your taxable baseline? The structural answer there is a definitive no. You see, a third-party compliance form is merely a gross revenue sensor. While top-line revenue tracking is completely automated by these third parties, calculating your actual taxable profit mandates rigorous expense reconstruction on your end. The gross data must be reported to match the system's automated records, absolutely. But it is immediately offset by allowable documented business expenses. So the final taxable income is the resultant net, which is frequently just a fraction of that tracked top-line revenue. Let's shift gears to part 3, cross-border tax mechanics and international logic. When we analyze the foreign tax credit, a really vital, non-obvious detail emerges. Typically, taxpayers use the paid method. This means taking a credit on a cash basis when foreign taxes are physically paid. But there's an alternative, the accrual method, where you take the credit when taxes simply accrue. However, and this is the kicker, electing the accrual method is a permanently binding structural decision for all future years. It is literally a one-way regulatory street. Why? Well, it's designed specifically to prevent taxpayers from opportunistically flipping accounting methods year by year, to game foreign exchange rates or manipulate tax timing. Another key concept here is the sourcing of income, and this really cuts through a lot of international compliance confusion. A very common implicit assumption is that the payer's location dictates the source of the income. In reality, sourcing is strictly determined by the physical location where the personal services or labor are actually performed. It is entirely independent of where the paying company happens to be headquartered. So, if work is performed abroad but it's paid by a domestic entity, the compliance engine fundamentally classifies that as foreign-sourced income. Now, for foreign government or international organization employees working domestically, the standard compliance machinery fractures a bit. Because these entities are immune from standard domestic withholding, the employees are forced into a strict, self-directed structure. They have to mathematically calculate and pay self-employment tax independently, and they are rigidly required to make quarterly estimated tax payments just to prevent severe systemic penalties from accumulating. Navigating these cross-border mechanisms requires an exact, logical sequence to prevent double dipping. First, the foreign source income must be mathematically isolated. Then, the system demands strict verification that the foreign tax paid was actually a compulsory payment, meaning it wasn't just some voluntary exchange for specific economic services. Finally, meticulous adjustments have to be made to remove any excluded income from the calculation. This rigid protocol ensures exemptions and credits do not overlap. Finally, we reach part 4, professional diligence and accountability, or what we can call the preparer's burden. In the professional realm, accountability isn't just a vague concept, it is mathematically defined. A practitioner cannot just sign off on a whim or an educated guess. They are strictly bound by what's called the reasonable basis standard. This is a rigorous regulatory requirement demanding that a practitioner possesses a genuine, documented belief that a specific tax position has a greater than 25% likelihood of success if it were to be formally challenged by authorities. The regulatory framework essentially transforms tax professionals into the system's first line of defense against reporting breakdowns. Active compliance requires maintaining that reasonable basis for all claims, of course, but it also mandates evaluating subordinate performance regularly. The goal is to intercept systemic, firm-wide failures long before bad data is ever submitted to the engine. Furthermore, practitioners must meticulously verify the highly specific qualifications required for complex credits. Another fascinating aspect is how regulatory mandates ensure that data flow cannot be weaponized. A practitioner must promptly return all client records necessary for federal compliance. This rule is absolute. it guarantees that even amidst a bitter professional or financial dispute between a client and a preparer, a taxpayer's underlying compliance data can never be held hostage. The administrative tracking engine relies on uninterrupted data flow to function, so it legally protects that flow. Furthermore, due diligence requires practitioners to look way past surface-level narratives and actively verify regulatory facts. For example, let's say a client is claiming a specific earned income credit based on a dependent's disability. The practitioner is required to actively document that the medical condition actually meets the strict 12-month legal threshold. They are actively required to audit the factual basis of a claim. They cannot merely act as a passive transcription service for whatever assertions the client makes. So what happens when the enforcement system itself actually breaks down? Well, there is an exact, step-by-step structural mechanism used to escalate the issue. It begins by filing a formal complaint through dedicated ombudsman or advocate channels. This single action immediately triggers a mandatory high-level agency review, completely bypassing standard processing lines, and ultimately results in a formal determination and resolution. And when that systemic advocacy intervenes, it yields highly specific structural resolutions. Based on expert reports, the three most common actionable outcomes are penalty abatements, which remove unfair fines generated by automated system errors, expedited processing, which is used to unclog severely delayed returns, and direct account corrections, which forcefully rewrite deeply embedded systemic data errors that automated systems can't fix on their own. But we have to ask, what happens if the threat to the system comes from the inside? What if you suspect a professional is actively promoting an abusive or completely fraudulent compliance scheme? Systemic integrity relies heavily on ground-up enforcement, and when standard escalation fails, the system has to switch from administrative correction to active policing. To maintain structural integrity, these regulatory frameworks maintain dedicated whistleblower channels and highly specific reporting forms to flag suspected fraud, improper promotion, or gross professional negligence. Because internal audit bandwidth is fundamentally finite, authorities implicitly rely on this distributed intelligence, basically reports from the public and from other practitioners. The network itself is utilized to identify and excise bad actors. So, as we wrap up, I want to leave you with a crucial thought. As these regulatory nets widen, as third-party tracking aggressively expands, and as monetary thresholds continue to drop, every single operation faces a structural question. Is your entity built for proactive transparency, or are you unknowingly accumulating hidden compliance debt that will eventually trigger the system's automated alarms? It's something we all need to deeply evaluate. Thank you for joining me on this explainer, and keep exploring the mechanics behind the rules.